All right, hello, ladies and gentlemen. Good evening, everybody, and welcome to another Portfolio Friday for 2000 Cashflow live with Terence, or I'm Possible Terence over here. Now, I hope all of you had a great week, all right? And boy, this market is crazy, all right? Market is just not giving anybody, all right, an opportunity to get out or anybody a chance to breathe at all. All right, now, so first, let me get everything in order and we'll start the session, okay? Hi, Joff. All right, and hi, Susan. All right, hi, Mei Ling. All right, okay, good to have all of you back here again. And all right, I'm pretty sure everybody's very eager, right, to find out, okay, exactly, all right, why the market is behaving this way. All right, and I definitely have an explanation for you, right? Just like the comments that I left prior to today's session, right? The whole matter of what the market is acting on right now is the fact, all right, that it is clouded. Right, the whole judgment across the horizon is clouded. Nobody is sure. Nobody is aware of when, right, or just when the interest rates is going to stop rising. Right? Why? Because the Federal Reserve came out and raised interest by 75 basis point again. Right? Is that drastic? No, it's not. Right? Because the higher end is actually 1%. Right? So they actually raise it in line. Right? But it is what the chairman, right, Powell said, right, that spooked the market again. He didn't give a definite end to when, right, the Federal Reserve will stop rising interest rates. He didn't even give a cap, right, as to what the Federal Reserve interest rate target actually is, right? So that leaves room open, right, for discussion. People are afraid, right? People are, sorry, give me a minute. Right? People are actually afraid. Why? Because without being sure, right, of how high interest rates can go, right, people tend to overreact. Right now, what do I mean by overreact? Right now, I do expect the Federal Reserve, right, to hit a ceiling at around about 4%. Right now, 4% is going to make things pretty drastic, right? Because if you think about how it behaves right now, right, the home loans, right, or the banks will usually mark up their interest on their loans about 2 to 2.5%. All right, now, so if Federal Reserve rate hits 4%, all right, that's going to make home loans anywhere from 6 to 7%, right, in terms of its interest rates, right, and that is definitely going to kill, right, the investment market for properties. Right now, if similar thing happens across Asia and the rest of the world, right, then we're going to have that drastic, flow over effect. Right now, so this is definitely the time, right, to watch, your leverage over here, right, and make sure you're staying in check, right, because things might just get harder. Yeah, okay, now, so because of that, all right, and because of the fear that is now spiraling into the market, right, okay, the market is structurally damaged, all right, it's psychologically damaged, all right, technical wise, all right, if you've been looking at the charts, it also starts looking damaged, all right, but the end is not near. All right, now, why do I say the end is not near? Because if you look at the market today, all right, now there's something I want to show you today. All right, today is, all right, or the last couple of days, all right, we see things have, kind of change. Okay, now, what do I mean when I say we've seen things that kind of change over here? All right, now I want to show you something very different. All right, now, because in the past, all right, when you have a day where it's all red, right, now this is what they call the heat map over here. Right, and if you look at the heat map, you still see pockets of green. Right, but today, right, we have things that are really, really red over here. Right, and if I go to index watch, okay, and I go to pull out the S&P 100, can you see this, ladies and gentlemen? All right, out of 100 S&P 100 stocks, 93 of them are down. All right, okay, this is what we say as a correlation day over here. All right, we have some defensive that's barely up. All right, that's Colgate, that's Amgen, all right, that's Adobe, all right, that's LLY, all right, and what do we have here? J&J. All right, so we have some defensive sectors which are still staying strong, but generally 93 out of 100 stocks are all down right now. Right, so this is a fear-all market, right? Because of uncertainty, right? The market is selling. Sorry, the market is selling everything. Right, and this is something we have not seen for a long time. Why? Because while markets were coming down, right? Okay, the momentum people, right? Okay, or the algorithms were still chasing, right, stocks with high valuations. All right, that means the market darlings like Apple, the market darlings like Microsoft, the market darlings like Tesla. All right, okay, they were staying strong. They were keeping the market strong. Right, but if you see what I'm seeing over the last week, all right, these stocks are leading the charge downwards. right? That is a very bad sign. I say that's a very bad sign because right now, if you just look at how things are reacting, the market hasn't even started buying into value stocks. And that's a problem because if they're selling everything, all right, and they're not buying value stocks, right, that means nobody's willing to get into the market yet, right? Or the shift in the portfolio managers towards buying value is still not there. They're still hoping the market will stabilize. They're still hoping the market will recover. And then they can put their money back to chase after performance again, right? But time is short. Why? Because portfolio dressing is going to happen, right? The end of the quarter is nearing, right? Okay, we're nearing the end of the third quarter, which is the end of September, right? So portfolio managers now are scrambling their head, trying to think what stocks they can keep in their portfolio before they have to report to their clients and show them the stock holdings. All right, so they have a big dilemma right now because everything looks bad, everything looks ugly. Yeah, okay, right now. So if they don't buy value, and they can't, you know why they can't buy value? Right? Because let me just show you what's happening. We have a few value stocks in our arsenal right now. Okay, now, so let me show you. All right, we have Intel, right? They can't buy Intel. Why? All right, because if you if you look at Intel's chart over here, right, it looks terrible. Right? They can't show their client a stock in their portfolio that looks like this. The client's gonna ask them, this is exactly why you lost me money. How can you hold stocks like this? And how are they gonna answer? They have definitely no answers for that. All right, now, and they can't hold stocks like KSS. All right, yeah, KSS pays a good dividend. Look, all right, what is this? All right, let me just change this up. Yeah, all right, now KSS is a 5 PE. It pays a 7.7 dividend return. Right, it makes money, but the fund managers can't buy this. Why? Because if they go to the charts, their clients are going to question them again. All right, it's the one with the red and green line. Right, you mean you lost me money because you bought a stock that looks like this? Why am I paying you to invest for me? That's a problem. All right, now, thank you very much, Tan. All right. I got overzealous in what I want to share. All right, now, so this is definitely a problem that fund managers have, and they need a quick answer for this, right? But something I want to put to your attention over here, right? And this is something that you will only be aware, all right, okay, when you have, tons of experience in the market, you know where to look for clues, all right, okay, and why, all right, okay, why, right? I'm picking stocks that I'm picking, right, to build this portfolio, and why I continue to invest or allocate without fears. Okay, now I'll point you in a certain direction, right? But before I get there, right, let me get things in proper, right? I do need to put out a disclaimer, all right, that all forms of investment bears a risk of loss. So if I do talk about any trades, right, that I might add or put or manage into my own accounts, right, those are my own personal judgments. They're not any form of recommendations at all. Yeah, okay, so please be aware of the risk involved before deciding to follow any of the trades in your own accounts. Okay, so now that's out of the way. Okay, now so let's get back over here. I want to show you something interesting. All right, now I'm looking at this counter called VTV. All right, now if you look at the top over here, this is a fund by Vanguard. Right, it's an ETF fund, right? But it's a Vanguard created value fund. Right, so what we call over here is a basket of value stocks. Okay, now so there's a basket or an ETF, right, comprising of value driven stocks. Yeah, okay, now, and the performance is marked by this red and green line. I'm taking a very, very long-term approach, right? So this is a 20-year monthly chart, okay? 20-year monthly chart. Okay, I want you to see the performance, okay? Now, but of course, we need to benchmark it or compare it against something else. So if you see my comparison chart, which is the one in the blue line, all right, it's with this other symbol called VUG. So let me show you what's VUG. The VUG is actually another fund. Right, it's also another fund created by Vanguard. All right, but this fund only invests in growth stocks. Right now, so why am I doing this comparison? Simple, right? Because growth stocks are also what we call momentum-driven stocks, stocks with pretty charts, stocks of companies that are growing. All right, I want to show you this because many people constantly argue. Right, Terence, why do you buy all these boring companies? Why don't you invest in Tesla? Why don't you invest in, all the pandemic-driven stocks? All right, or CrowdStrike, C Limited and stuff like that. Right, because in the near term, right, many of you may have seen great performance over the last 2 years, right? But these are pockets or these are windows that provided if you even get the stock choice right, okay, you stand to make these kind of over large or outsized returns. But if you don't get it right, you face a very big problem. right? And the problem is this, right? Okay, now, because if you look at the long term, this is the 20-year, right? Okay, I want to show you this period, right? If you look at this period over here, that's what? 2009 February, yeah, okay, 2009 February, all the way, right, until here, right, which is August 2015. So about 2009 to 2015, right, what do we have? Right, we have that market crash, if you remember, right, and then the recovery from that market crash. All right, now, can you see the performance of value funds, of value stocks, all right, against growth? Can you see that? Yes, both are rising, but can you actually see that it's outperforming? Because if you look at value over here, during that period of about 5-6 years, right, value is actually returning about 70 over percent. Where else, right, growth stocks only recovered and turned positive, yeah, okay, by 17%. Right now, both were down, definitely. Market sold off, right? Value stocks were down 36%. Yeah, okay, but if you look at this, growth stocks were actually down more than 50%. So if you look at this, the first thing you should notice is this. When you invest only in growth stocks, right, when markets turn bad, right, you have a huge downside, right? You have a huge downside, right? Whereas if you invest only in value stocks, yes, it will fall as well, right? But you're looking at a much more limited downside, right? And when the markets actually recover, yeah, okay, it actually outperforms as well, right? But I know many of you are going to argue, but Terence, that's not the case in the last 2 years. Yes, I agree. Why? Because the last 2 years, right, were driven by something totally different. Here, we have that pandemic market crash, right? Okay, back in 2020, all right? And that is the only time, all right, where you see that growth stocks finally caught up. Can you see over the last 20 years, it is only during this period, right, of the last 2 to 3 years where you saw the market or this growth stock, right, actually outperform value, right? But when the market turned, look, right, once the market turned in 2022, January, right, what do we have? Right, you have that quick correction over here. And growth stocks wasted no time, right, in terms of how they corrected and start falling way below value. Can you see that? Right. So if you look at this, right, growth stocks went from 222%, all right, all the way down to 120, which means their returns literally halved, right? But during the same time, right, we have value stocks that are up about 198%, right, which is not too bad, right? And they are now down to about 150. So we have, all right, value stocks, right, falling about half, all right, in terms of the dip, okay, versus growth stocks. This is a stark contrast over here. Why? Because from here, right, if we get this swing back, I'm not saying it's going to happen now, tomorrow, or anytime soon, but when it happens, now with higher interest rates environment, now with money being more expensive, right, which stocks do you think are going to move up faster? Do you think it's still going to be these rate hot growth stocks? No, because growth stocks are not going to be growing like how they grow over the last 2 years. No. All right. People are not going to be, as blinded as what they did in the last 2 years because they can see now. All right. Look what happened to so many of them. All right. Look what happened to Peloton. All right. Look what happened to DoorDash. All right. Look what happened to Bed Bath and Beyond. Yeah. All right. All these companies are left for dead. Look at GameStop. Look at what else. All right. What's the cinema company? I can't remember. All right. All of them are left for dead right now. They're all struggling. Right. And they're not even making money. Look at Snap. Right, it's gone as well. And in fact, all right, I want to show you this. All right, let me erase everything now. All right, let me just go back to the last 2 years? I think 3 years. 3 years daily is not good. Let me just go back to 3 years weekly. Yeah, all right, let me erase everything. All right, let me take away this comparison, apply. Let me set the charts back to the normal. Okay, we're back to normal. All right, now, so what I want to show you is this. One of the hottest darling, all right, that everyone believes is going to be a growth stock. Look what happened. Spotify. All right, Spotify. What did they do? The biggest stock interest is this. You must understand, when companies do not make money, you just don't invest in them. All right, okay, yes, I know many of you are going to argue, but Terence, most growth companies do not make money at the start. Yes, but that's exactly the risk that you're taking that you hope to be rewarded for. But whenever you're wrong, right, and especially if you chase after it, All right, you have a big downside. Look, Spotify was being chased 387. All right, when is 387? That's just February this year. No, February last year. All right, and then what happened? It just kept spiraling down. And where is it right now? 90. 90. All right, and I'm telling you this, 90, and it's still expensive. Why? All right, because how long has this company been around? How many of us are actually subscribers of Spotify for the longest ever time? I still am, and I tell you this, I'm paying the fees, but all right, I won't invest in this company. Why? Because it's never made money. Can you imagine that? They've been operating this service, they're one of the biggest, and yet they still can't find a way to make themselves profitable. So do you actually think that they can right now? They are already one of the biggest and they still can't make money. That's a problem. And they are literally showing right now with the stock price. That's a problem, all right? At 90, if they still can't make money, I don't know, why are you buying this stock? All right, why do you want to buy the stock? Because if you look at the assets, all right, how much is the asset worth? The asset is worth $12. That's how much this company is worth. Because if the company declares bankrupt, that's all you're going to get back. Right? And you're paying $90 for it and you think it's cheap just because the stock fell, right, by more than 60%. No, you shouldn't. Right? This is a totally different, different story altogether. Yeah, all right. Now, when things get too expensive, when markets are not doing well, right, these stocks will get punished. Right? And even markets, even when stocks are too expensive, right, even if they're making money, right? So we're talking about companies like Apple. Yes, they're making money, right? But there's a problem. The problem is this: they're trading at 25 times PE. All right. Now, so imagine this. Okay. Now let's do a comparison and let's have a look. All right. I've never done this before as well, so I'm going to do this live with you. Okay. All right. Now, so right now, so net profit margin of Apple is about what? 25.88. All right. Now let's just do a quick comparison over here. Nice. Look. Right? 25.88 for Apple, 25.14 for Intel. For Intel. Right? So can I say the net profit margin is very similar? Right? So both are operating slightly different business, their technology, but still slightly different. But both have very, very similar, right? Okay, profit margin. Right? And yet, right, the market is happy and willing to punish Intel stock price to a 5 or 6 PE. Right? 6 PE. All right. And you think Apple at 25 times PE is considered cheap. Why? All right. People consider cheap, and people are actually thinking of bargain hunting Apple, right? Just because the stock fell from 180, right? What? 180 down to what? 150. No, even here, right? Even here at 130, I'm telling you, it's still expensive. Why? Because if they can beat down, right, companies like Meta, right, to an 11 PE, right? If they can beat Meta to an 11 PE, right, what makes you think, right, that when things get serious, things get really bad, that they will not push Apple down to 10 PE as well, right? And you can only see what's going to happen. Why? Because Apple is now 25 times PE. So you're looking at least half the stock price, right? So if Apple gets to 80, right? If Apple ever gets to 80, I'm saying it actually can happen. That's the time I'm thinking of buying Apple. Why? Because it's profitable, right? And at that time, it's finally cheap. Yeah, okay, all right. Now, and even, let me show you this, Google. Right, you want to look at Google, right? Even after the split, people say buy the split. You go buy the split. Look what happened, right? Google is at 150 highest, right? And now it's 100. Right? It's down by 30%. Right? And I tell you this, Google down by 130% is still not cheap. It's still 18 times PE. Yes, if you value Google, right, okay, based on its past performance, yes, it is cheap. But the market is not doing well now. Interest rates are going up. We have recession that's out of control. Yeah, okay, even Google says they're freezing hiring. All right, and Google is cutting staff. All right, they're firing people right now. They're closing divisions. Yeah, okay, all right. Why? Because they themselves see that times are getting harder, right? How many of you are starting to see that week after week after week, you're starting to see American companies announcing that they're doing job cuts? Yes, all right, because it's getting real, it's getting serious. Yeah, okay, all right. It's getting very real over here. All right. Now, it doesn't matter, Cole. All right. It doesn't matter how big the large fan base is. Why? Because when the fund managers' hands are forced to act, that's when trouble comes. Right? It's not about a big fan base over here. Right? They can ignore valuation for the near term. Right? When things still look good, you must understand. But when things start to get bad, it is a case of sell all and sell everything. Yeah, okay, sell all and sell everything, because anything that's expensive, right, in terms of valuation will be punished by the market. Right? When market finally realize that it's time to move to value, right? It may be hated by some big investor or something like that. But once it's hated, money is going to start coming out of expensive stocks and moving into cheaper value stocks. And when that happens, you see the migration of money. All right. When you see the migration of money happening, all right, okay, you better be ahead of this curve. All right. And that's really why I want to take this session today, all right, to talk about. Yeah, okay. You may say, oh, Terence, you're so negative today. I'm not trying to be negative. I'm trying to be real. Right? Because the markets are getting real. This that we see right now, I want to tell you this is normal. I say it's normal because this has been coming. It's been building. It's been bubbling for more than 10 years. This is the moment that we've been harping about. Right? The bears have been punished for 10 years. Why? Because they've been too bearish. But this is now real. Right? This is now as real as it gets. Why? Because everything is out of control. Right? Simply because, right, of what the Fed did over the last 10 years. They kept blowing a bubble, right? And the bubble got bigger and bigger and bigger and bigger, right? Yes, the bubble didn't burst yet, right? But they are now in a hurry to deflate it, right? They're not trying to let it go slowly because they can't, right? They're trying to deflate it as quickly as they can, all right? And that's, I don't know how you want me to say it. That's real, all right? Okay. How big? Cool. Let me ask you this. How big a fan base do you want? Are you telling me Tesla fan base is big and Meta didn't have a big fan base? All right, okay, because I'm not trying to make you the attention, okay, cool? All right, but this is a very important statement I want to address over here. All right, yes, in the short term, all right, when things are good, when everything looks good, people ignore valuation. All right, but now money is coming out of the market, money is getting expensive, money is moving to bonds. Yeah, okay, you must understand something. Money is moving to bonds. Why? Because interest rates are getting higher and people are afraid. Yeah, okay, so when money moves to bonds over here, yeah, okay, because of flight to safety, that means they're coming out of the market. People are withdrawing from their funds. And when people withdraw from their funds, money is flowing out. When money flows out, right, then what do you think is going to happen to stocks with valuations like that? I don't know. You tell me. Right? Because when you are afraid, okay, now let's do a very, very quick exercise, okay? All right, now, when you are afraid, okay, when you are afraid, we do a like for like comparison, okay? Now, we have Tesla, okay? We have Tesla right now, okay? I'm not saying it's a bad company, okay? All right, now, but we have Tesla. If you look at the records over here, all right, 2017, 2018, 2019, losing money, right? In 2020, finally makes a profit, right? 2021, better, 2022, current, all right, even better, okay? Now, but if you work it out, okay, let's give it the benefit of the doubt, okay? All right, now, so if it stays where it is right now, okay, now, so assuming the consistency that it gets, so it makes about average 250, right? It makes an average of about 250 per quarter, okay, 250 per quarter. So this company, all right, if you add it up right now, 2.5, 2.27, right? So let's combine these two together, right? And it makes 4, right? 4, 5, 6, 7, 8, 9, right? $9.50, close to $10. So Tesla is a company that makes $10 per share. Okay, all right. But to buy this company, it costs you 277. All right. Now I want to give you a separate comparison of here. Right. On the other hand, we have Dow Chemicals. Okay, we have Dow Chemicals that trade at only 5 PE. All right, and on top of that, it actually pays you a dividend return of 6.5% right now. Okay, 6.5% return right now. And if you look at the earnings, right, 2.75, 2.15, 2.34, 2.31. Is that close enough to $10 as well? All right, I don't know. What say all of you? Do the profits per share, earnings per share, all right, look similar for both the companies I just showed you? All right, for both companies I just showed you. Can you leave a comment? Tell me yes or no. Yep. All right now. So Cole, thank you very much. You agree with me. All right now. So you're saying that both the earnings per share are similar. All right. But you have a choice right now. You can pay $300 to buy Tesla because, oh, there's so much potential. It's going to continue to grow. But you have to remember the law of large numbers is always going to be a bit. Okay, I don't want to blurt that out. Yeah, all right. Now I say it's always going to be a bit because that's what happened to Intel. Why do you think Intel is suffering right now? Because they made so much money that even $1 billion more isn't significant anymore. Right? But when you are only making 1 million in profit, and when you can make 10 next year, oh my God, you just made 10 folds. But when you make 10 million and you turn it to 11, oh my God, you downperformed. All right. And that is a problem. All right. That is a problem. So do you want to do that? All right, by paying $300 for Tesla because of its future potential that is unknown? Or do you want to pay for a company like Dow, which has been a business, right? It's a boring business, chemicals and solutions and stuff like that, but it makes money, right? It makes money and it pays you money, yeah, right? And it pays you, even if the stock doesn't move, you still receive 6% right now, yeah, okay? And it only costs you $43. How about that? And look at this, right? This is a company, a big blue chip company, right? That's fallen what? By about 40%, 40% down, all right? And what's your downside? What's your downside? If I make you buy a local blue chip stock, let's say DBS, let's say whatever, DBS Capital, whatever in Singapore context, after it's fallen by 40%, how much more downside do you really see? Right? But if I ask you to buy a growth stock after it fell by 50%, is there still a lot of downside? That's the difference. It's always about risk. I know many of you are focused on returns, right? But you need to take care of your risk first. Why? Because it's useless even if you can make 1,000%, but you have to bust your account before it gets there. Because once your account goes bust, you have nothing left, right? So even if the stock makes you 1,000%, you've got nothing, right? Because you blew it before it got there. All right. So you know, in this market, the best thing I can let you take away from today is you need to curb and measure your risk all the time. All right. Look, ladies and gentlemen, I believe I did this, right? Even in this public session, I nagged at all of you, right? I nagged at all of you here. All right, let me bring it back. Here, when the market was going up, here, when the market rebounded again, during those pockets, I keep harping. If you have any of these growth stocks, right, that you're still holding in your portfolio, all right, okay, you need to think about what to do to them. All right, now over here, many of you, think it was a joke. All right, when it came down, right, yeah, you felt painful, but when it bounced up, oh my goodness, Terence is wrong. All right, I don't know, I'll leave it to you because this date was what? 12th of September. All right, have a look. 12th of September, where's Apple? Here, 12th of September, Apple is at 160. All right, where is it now? 150. All right, okay, now, what else do many of you have? TSM, I know this is a hot favorite. Taiwan Semiconductors. All right, where is it? All right, 12. All right, you may have bought it here at 87. All right, and at 82, you don't want to get out. That's a $5 loss. All right, you don't want to get out. Where is it now? 73. All right, and is there a bottom? I don't know. Where's the bottom? Because if market keeps going down, all right, tech stocks are going to suffer. All right, is this stock really cheap? All right, 14 times PE. All right, it can still go down to single digits. So there's still downside possible. All right, so this is all the risk that we're looking at over here. Now, having said that, all right, I'm not spared. All right, now why do I say I'm not spared? Because now that I've talked about the market, now that I've got you all afraid of, all right, now I know many of you are saying, but Terence, your portfolio is not doing well. All right, I don't know because I've got 1 month to get myself out of this fix, out of this situation. I've got 1 whole month, right? That's why everything needs a plan. Everything requires planning ahead of time, right? And as long as you know what you're doing, then once the plan is running, leave it to run and manage accordingly. All right, now look, we have positions, all right? We have positions right now that are running. Right now, this is my portfolio. Is it ugly? I admit it's ugly. Why? Because I have WBA shares that I paid $45 to own, and now it's 32. I'm down. But if I don't sell the stocks, then it's paper money. It's paper losses. Why? Because to me, I put up the money. I have the money sitting in the account to own all the shares. I'm not leveraged. That means even if this stock falls by 50%, I have that money there. It's sitting in my account. I won't fear facing a margin call. All right, so I can hold this stock. Why? Because I just want to say this. Many of you will be thinking, Terence, it's so terrible. Isn't it time to call it quits? Why do you want to call it quits when a blue chip stock is hitting a rock bottom? All right, I promise you, if you keep doing that, right, 6 months down the road, if you look back, you're just going to regret this decision, right? That you made yourself so afraid, right? And you got yourself out. Now, okay, the time to get out is always when there's a bounce, right? Not, not when the entire market is hitting a bottom and your stock is hitting the bottom as well. That's the worst decision you can get. Why? Because just looking back, right, if you go back to Walgreen Boots over here, right now, first, Walgreen Boots, is it paying dividends? It is. What does it mean? It means the company has cash flow. Second, right, is it a positive PE? Yes, it is. What does it mean? The company is making money, right? Third, all right, let's go back. Let's pull out what, 20 years, 10-year monthly. I think is good enough. Right? If I stretch it out, is the company making money? Making money, 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 making money. The company has never lost money every single quarter over the last 10 years. All right. And now you're telling me, right, the stock is at its lowest. Look, this is the oh my goodness. You're telling me you want to get out now? I just saw this. Ladies and gentlemen, a company that makes money never fails to make money, and you're telling me you want to get out now? Do you think you're going to share this decision or you're going to regret this decision a few months down the road? Stock market, all right, is never efficient. There are always inefficiencies, and that's why there are always cheap stocks that you can find that's worth investing. And this is a classic situation that you're seeing right now. All right. And because this stock is so cheap right now, let me tell you a positive spin to it. I'm not saying it will happen because this company is massive. All right. But because the stock is so cheap, look, 97 to 30. And the company is making money. Let's just do a comparison. All right. So at 97, the company makes $1. All right, and at 30, the company makes $1. All right, so at 100, it makes $1 per share. All right, at 30, it makes $1 per share. It makes the same, but the valuation is 1/3. It's down by 65%. What do you think a fellow competing company would think with this database, with this, reach and everything? What do you think this company looks like right now? It looks dirt cheap for the slaughterhouse. Yeah, all right. Why for the slaughterhouse? Because if anybody wishes to buy this company now, it gets everything it runs, it gets everything it owns, right? It gets all the profit it makes, it gets all the stores to continue running this profitable business at 70% discount. Right? Even if they overpay by 20%, it's still a massive discount. All right, now, so I don't know, you go ahead and sell it. Yeah, okay, yes. Go, that's exactly it. That's exactly it. That's why I started the session, right, with showing you the comparison of the chart. All right, and many of you need to shift a focus because many of you are always looking for short-term gains. Now, I'm not saying it's wrong, but when you trade short-term, you must recognize something and accept it, right? When you trade short-term with a short-term goal and a short-term focus, all right, okay, you need to stomach bigger risk, all right, and higher chances of losses, all right? But when you have a long-term goal, all right, but long-term aim, and you trade shorter term, all right, you can always rely, all right, on your longer-term analysis, all right, and that's the thing you need to build, all right, okay, and that's why fundamentals always supersedes and overrides technicals. Because when I'm wrong, fundamentals is what supports my decision. Is what keeps me in check. All right. And that's why people keep telling you never ever leverage. Because if you leverage, you're in trouble. Yeah. Okay. I'm building this portfolio. All right. All I'm trying to achieve over here is something very simple: $2,000 a month. All right. And over the last couple of months, we have done that. All right. And here's the best part: even if I don't do anything at all, all right, even if I don't do any more new trades for this month, right, until October expiry, I'm already there. Right. I've created $2,000. I've locked in. Right. Based on all the options I've sold, I've collected 2,000. Right. I don't even need to do anything anymore. So if the market stays this way, right, I'll still hit my target for another month. Yeah, okay, but I do think that things are as bad as it can. Market is really severely oversold. Right, we can see a bounce. Right, and when this bounce comes, it actually can get pretty wicked. Right, but this is the time you have to learn to sell the rally, sell the bounce. Right, because all the bounces we get right now are basically correction rallies. If you still think that we're going to hit a new high by the end of the year, right, you need to rethink. You need to recalibrate. Because many people are wounded. Many fund managers are going to lose their job and get fired. All right. Okay. Do you think there's enough money in this market, right, to push everything to a new high? No, it's not going to happen anymore. Because for a new high to happen, you need a new high to come on stocks like Apple, on stocks like Amazon, on stocks like Google, on stocks like Meta, because these are your big fives. All right. These are your $1 trillion market caps before the correction came. Right, and many of these stocks are down by 30 to 50% today. Right, is there enough money, right, to go back into the markets and push all these stocks higher? No. All right, look at Nvidia. Right, it's also severely punished. Yeah, okay, and Nvidia should not be bought right now. I know many of you are thinking, oh my goodness, all right, this is great. Nvidia is still expensive. It's 40 times PE. What does it do? It does chips. All right, you've got a whole array of selection. All right, you can buy chip making companies for 40 PE, or you can buy chip making companies like Micron for 5 PE, like Intel for 5 PE. All right, even the one that I dislike, AMD, is still cheaper at 28 times PE. And you tell me you want to buy Nvidia. All right, and let me tell you this: what did Nvidia just announce this week? If you didn't pay attention to the news, they're going to start selling their chips for a higher price. All right, and they believe, right? Even the CEO said this. They believe that gamers, which are their main markets, right? Yeah, customer market. They believe that gamers will continue buying it. People are going to lose their job, right? Money is going to get more expensive. People have already overspent their budget, right, before this came about. And you believe, right, that gamers are willing to pay the extras? I don't know what they're thinking. All right, maybe it's a good strategy for them. Yeah, okay, but it's definitely not gonna work. Right? It's not gonna work. Yeah, okay. Anyway, all right, it's too much negativity. Let's go back. Yeah, all right. Hang on. Okay, right now. So my next bleeding stock is of course Intel. All right, Intel is now at what? 27. All right, so yes, we're down as well. All right, but I've allocated money, so that's fine. All right, I got to sign. Sorry, I got to sign a. Did I get a sign ANF? Yes, I did. Did I? Yes. I took that stock. All right, so let's see where ANF is. Oh man, where did my ANF go? There we go. All right, WBA, Intel, ANF. All right, 1546. All right, now, so we're just going to hold the stock because I got it at 18. All right, okay, so I won't be able to generate any cash flow for selling call options, so I'll leave it. Yeah, okay, my next one is VZ. All right, it's literally down as well. All right, okay, but I'm fine, right, because I'm collecting a 6% return, right, while waiting for the stock to go back up. So even if I don't sell any call options, this stock is going to pay me 6%, right, in 1 year, just from a form of dividends. I'm okay. All right, now next one. All right, AT&T. All right, our options expire on the 21st of October. We have an 18 put. It's down to about 16. That's fine. All right, now we have KSS at 26. All right, we have a $30 put, so I'm down. Yeah, okay. I have a TSN 77.50. right? It's 70 right now. I'm fine. Yeah, all right. So look, I'm bleeding. Yeah, okay, but that's fine. That's all fine. All right, I go at about 14.33. We have a 15 put, so this one still looks decent. We might be salvaging it by October expiry. All right, we have a Haynes Brands at 9. All right, and Haynes Brands right now sits at 7.8. Right, so we're under as well, right? But still a chance, right? And then we have Pfizer, right? Pfizer at 45. Right, Pfizer at 45, we are not too far away, just $1, right? So this can possibly turn around by October expiry, and we have OMF to wrap things up, right? So OMF $35 puts, all right. Here we're down by about $5, so I'm blood red, all right? I'm blood red as well, all right? But I've got the money. The money is allocated, ladies and gentlemen. Right, money is allocated, right? So I'm not severely over leveraged, right? Based on 100%. For all stocks assigned, and based on my 70% leverage rule, right, for margins for all the portfolio puts, right, I need a capital of about 170, right, 170, right, and my portfolio has since grown to 111, right, after accumulating $2,000, right, consistently for 5 months, right, out of the 12 that we are looking to build, right. I'm already halfway there. Right, and plus this month, even if I don't do anything, I've already met my goal for half the year. Right, for half the year, I've achieved all my monthly goals. Right, and that's fine. All right, that's fine by me over here. Right, and even if I get assigned all the stock positions, right, my total cash requirement to buy up all the stocks is 140,000. Right, 140,000. And remember, the maximum, right, the broker is going to allow me, right, in terms of cash value to own stocks is up to 220. All right, okay. So even if all my positions are assigned by the end of this month, I only need 140,000 to own all those stocks. Am I tapping into leverage? Yes, I am, a little. All right, my portfolio has 111,000. I need 140. I'm taking about what? About 30,000 loan. Do I expect all these stocks, right, to stay this low, right, for the next entire year? No, because many of these value stocks just catch a bounce, right, and they will recover within less than a month, right? We've seen it happen over and over again. I've been doing this for more than 10 years. I can tell you, anytime a good profit-making company, right, is severely depressed, it's like a spring that's being compressed, right, longer and longer and longer, right? And once it's let go, once the lid is opened up, right, it just springs back because everybody wants in, right? Once someone gets into a value stock and everyone wants to get in, money flows in, right, very, very quickly. And that's going to spark, right, that mounts up. So with that, all right, today there's not going to be any portfolio action, right, because I'm bleeding blood red. I'm just going to stay this way. My targets are met, right? So I'm just going to stay put. Yeah, okay, I'm just going to stay put, right? Today is really for me to reassure you, right, that I'm not panicking with any of these positions, right, because all these companies are sitting well, right? Let me show you. WBA, 5 times PE, Intel, 5 times PE, ANF, 12 times PE, not the best, but still okay. Verizon, 8 times PE, AT&T, 5 times PE, KSS, 5 times PE, TSN, 6 PE, Gold, 12 PE, all right, Haynes Brands, 6.5 PE, Pfizer, 8.5 PE, OMF, 4 PE. Ladies and gentlemen, all these companies are companies with track records of making money, right, for more than 10, 20, 30 years, right? And I'm buying them right now at anywhere from 4, right, to 8 times of their earnings per share every single year. I'm happy in my portfolio, all right? There's no reason for me to panic at all. All right, now, so yes, that's why I want to cover in today's session. All right, I'll be happy. All right, I'll actually be happy after nagging, all right, this long and this much, all right, to take a couple of questions. If any of you have some for me, all right, or help you calm some of your nerves and fears before we wrap things up for today's session. All right, so if any of you have questions that you want to throw into the mix, all right, leave a comment, all right, because I think I barrage too much, right? Nobody wants to leave comments. Today is a hate session. Hate Terence, right? Hate all his negativity over here. What the heck is he doing? I'm looking for some positivity, but he's not giving any. All right. if the market isn't giving one, right? There's nothing that I can hand to you. Yeah, okay. The only positive takeaway is this: if you got yourself in the right stocks, then there's no reason for you to panic. Right? There's really no reason at all. Right? But if you like my nagging, if you like my harping so far today, all right, do remember to hit the like, all right, or hit the like and the share button, right? Because I do believe whatever I shared today is a very, very important and valuable lesson, right, for anybody who invests in the stock market. All right. So if you can share it out, many more people can benefit from my craziness. All right. Okay, today. Right, I know that my lead over here from Chinsei. All right, hi there. All right, now, so yes, you can. Okay, you can. All right, but you must understand. Okay, when I get a PE valuation, all right, that's yummy enough. That's good. That's good, because if you're looking at boring cash cow companies with market dominance, that's already a good point, right? But if you can even get it below the price to book ratio, that just means, right, it is priced for bankruptcy, right? But a profit-making company that's priced by the market as though it's going bankrupt. So what situation do you have? You have like a drooling, opportunity. Yeah. Okay. All right. Now, Chinseng, I hope that kind of answers your question over here. All right. So Chinseng's question was, do we also look at price to book ratio? Yes, you can. Right. But PE ratio is good enough for boring companies. Right. If the P to B ratio also checks out, right, then it just made it even better. Yeah. Right, Andy, right, is it good to get into semiconductor stocks that is badly beaten? Right, I can only say this, right, as long as the company makes money, right, after it's wounded, right, all it needs is a spark of hope, right, and once the company can find that spark of hope, everything turns around very quickly, because you must understand this. Right now, the market hates Intel. Why? Because they are painting the picture that semiconductors are slowing down. Right, and they are still painting the picture that Intel is behind the curve, right? Intel is not making more than it should be, all right? But once Intel can turn around, all right, and paint a more positive picture, all hell breaks loose. All hell breaks loose on the upside. Why? Because like I said earlier, right, if you were comparing Dow versus Tesla, right, I know they're totally different, but just in terms of valuation, right, where do you think your money is going? Right, because once Intel can catch a wave, once the chart looks like it's going to break out on the upside, right, where do you think the fund managers are going to move their money? Right, they've got a company that has no problems when it comes to making money, right? And when the chart starts looking better, right, where do you think they're going to start pouring their money into? That's the whole analogy. Yeah, okay, all right, now, so selective, right? Selective semiconductor stocks, because if you believe in semiconductor stocks, then you should be picking the ones that are already badly beaten. Okay, also from a common sense logic, okay, from a more commonsensical logic. If you look at Nvidia fell from what, 346 down to 124, right? But can it fall much lower? Yes, it can. Why? Because just about what, 2020, right? Let's just take 2020. It was only $46 at 2020, right? Can you imagine if it goes back there? So if you buy Nvidia, that's your downside risk, right? Because if you look at this over here, this is the last support, right, or the nearest support, and it just broke below this month. All right, the next meaningful support is not until 75. There is a vacuum over here. There's a vacuum, all right, because this was a breakout move. All right, okay, there's a vacuum all the way to 75. Right, but if you do this, if you get in on Intel right now, can you see the difference? Right, 2020. Intel is here, and now it's even lower than it was at 2020, right? And what do you have right now? You have a support here. Intel is trading at a support, all right? Intel is trading at a support, and right, even if you say it goes lower, it has already fallen by more than 50%. It's fallen by more than 50%. Even if it goes lower, right? Your next support over here is at 25. That's what, a $2 downside. versus $75. Where do you want to park your money, Andy? All right, so that's where I hop on. All right, think of the risk. All right, okay, before you think of the reward. Yeah. All right. Now, if you go into trades only looking at rewards, all right, you're gonna be left, right, burning your fingers on many of these opportunities that you think are actually good, right, because they actually turn out bad. Yeah. All right. Okay, Andy. All right. Thank you very much for your questions. And seems like nobody else have any. All right. So just one last parting shot. If you enjoyed any of the content today, leave a like before I end the session. Share it out. All right. And of course, I'll be back with you next Friday. All right, for another session. And let's hope we have a better looking market. All right. We should have a bounce. Will you get it by next Friday? I don't know. Mr. Market has his own ideas. Right, but for now, please stay in, keep your hands in your pockets. Do not get into trades because the market is not telling you to get into anything right now. You want to go short, many of the stocks already are oversold. Yeah, okay, you want to buy, everything looks terrible right now. Okay, now is not the time to get in yet. All right, so just be patient. All right, just be patient. This is the time to be patient. Wait for things to be clearer. All right, and then get yourself in, ease yourself in. There's no rush. All right, the market has been around forever, it's still going to be there. Right, which means money can be made. All right, but don't kill yourself in the process. All right, thank you very much for joining me once again and giving me a Friday evening. All right, this is I'm Possible Terence. All right, and I'll see all of you next Friday once again. Okay, bye for now, ladies and gentlemen. See all of you really, really soon. Bye-bye.